All right, my friends, so this will be part 4 of our series on how to calculate your taxes in retirement. And what we're going to show here today is we're going to do a Roth conversion of $10,000 for our widow. So remember, when our widow was, when her husband died, her taxes went up, her taxable income went up by $15,000, even though her income went down by $10,000, her taxable income went up by $15,000 because the tax code is stacked against widows. That's just a fact. Now, remember, before she died, when they were married filing jointly, they did a Roth conversion because they had when we did our first case scenario, they had negative taxable income of $7,600. So we did a $10,000 Roth conversion, assuming to take advantage of our negative taxable income. And what happened was it increased our taxable income by $17,100. Even though it was only a $10,000 Roth conversion, we increased our taxable income by $17,100 with $10,000 of Roth conversions because that is how Social Security is taxed. A dollar of income increases your taxes by $1.70%, or at least it increases your taxable income by $1.70. That's what happens. So let's dive right into this for her. So remember, in this case, you got to calculate the provisional income. Again, that's going to be half of our Social Security, which is $10,000. We got her IRA distribution, but remember, $15,000 was her required distribution. We'll just say that for example. But now she's going to take another $10,000 for an IRA for Roth conversion. So Roth is $25,000 in total IRA distributions with the Roth. She has her tax-exempt interest. Now, spare you my tax-exempt interest joke of, but Josh, tax-exempt interest isn't subject to income tax. I'm not going to spare you. I tricked you. Yes, it is when it comes to Social Security taxes. It certainly is, my friend. It's not subject to income tax, so just keep that in mind. So here we got $10, $20, $45,000 of provisional income. So for a single person, the first $25,000 is not subject to any taxes whatsoever. All right, nothing. 25 to 34. 50% of that is subject to taxation. Anything above 34, 85% of that is subject to taxation. So here we got to take our trusty calculator and we see 34 minus 25 is $9,000, of which half that is subject to taxation, which is $4,500. But now we also got 11,000. 45,000 minus 34,000 is 11,000, which is subject to 85%. Is what we tax. So we take $11,000, times that by 0.85, $9,350, my friends. $9,350, which means in this case, she is going to have taxable Social Security of $13,850. Would be taxable Social Security. So let's do this. Tax SS 13850. All right? So, let's keep going on, man. I know I'm kind of flying through this one right here because it ticks me off. I'm not going to lie to you. No one seems to care about it. But, I mean, the Tax Foundation does a good job. I don't know any politicians that talk about this because, frankly, politicians, I mean, we got doctors, we got, I don't know, do we have any physicians up there? Do we have any CPAs? We got a bunch of lawyers as politicians. This isn't to say anything about lawyers. What do they know about numbers, though? What do they do in terms of the tax code? I mean, if you got a tax accountant, an LLM, more power to you. But are there any in Congress that can talk about the tax code and fix it? Frustrating. So now we got to figure out our AGI. So we take $13,850 of taxable Social Security plus we did $25,000 of IRA because we did $15,000 as a required distribution plus a $10,000 Roth conversion. So $38,850 is AGI minus $13,600 for standard deduction, which gives us what? 25250 taxable income. The first, and I don't know exactly what the number is off the top of my head, but roughly the first $9,500 is 10%. All right, so that gives us $9,500 will be $950 of tax. And then we take 25250 minus 9,500. 15,750 is times 12%. That's 1,890 plus $950. Our total taxes here are $2,840. $2,840 tax. Because we have the difference between this right here is, I forgot off the top of my head. Hold on just a second, my friends. But we know that 200 is our tax, so let's just get rid of that. So the difference between 25,250 minus 9,500 is 15,750 times 12%. Because remember that the single taxpayer has a different tax bracket than a married filing jointly. So here we got 2,840 of tax. And our taxable income is 25,250. And our tax 2,840. All right. So before, this is where it gets just disturbing. We had taxable income of $6,750. We took a $10,000 additional IRA distribution, regardless. It can be a Roth, it can be anything. We took a $10,000 additional IRA distribution. Our taxable income went from $6,750 to $25,250. That's freaking insane. That's $2,250 minus 6,750. It went up by $18,500. $850 more of taxable income on a $10,000 IRA distribution. I gotta say this again. We took $10,000 out. Our taxable income went up by $18,500. That, my friends, is the tax code. A $10,000 IRA distribution increased our taxes by $18,500. I cannot stress that enough. $1 of taxable income distribution from IRA increased our taxable income by $1.85. That's a fact. That is a fact. How many financial advisors, how many accountants are telling you about this? That, my friends, is a fact. And now our taxes went up from $675 to $2,840. 2,840 minus 675. So our taxes, we increased our taxes by we increased our distributions by $10,000. We took $10,000 out of our IRA. But our taxes went up by $2,100. So we weren't in a 10 or 12% tax bracket. We're in a 22% tax bracket. So even though we're only in the 22 to 12% tax bracket, because our taxable income went up by $18,000 on $10,000 distribution, we had to pay $2,100 more in taxes than we did before, which means we're at an effective 22% tax rate on that $10,000 distribution because the way the tax code is stacked against people on the lower ends for Social Security and for widows. All right, I'm mad, so I'm going to go. Got to go pick up one of my kids, but I'll give you a case study, a real live example. It's going to be similar to this here in just a second, so stay with me. We'll see you next time. Thanks now.